After the collapse of Silicon Valley Bank, some of you asked me if an SVB-like scenario is possible at a brokerage firm and what would happen to your assets if your brokerage firm went bust. The Silicon Valley Bank collapse unraveled so fast that people had no idea what to do. Should you spread your risk by keeping your 401k, HSA, IRA, and regular brokerage account at different firms? That's what I will discuss in this video. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Is there protection if my brokerage firm goes bust? The short answer is yes, but it depends. SIPC, the Securities Investor Protection Corporation, was created in 1970 under the Securities Investor Protection Act to protect some investors' assets from certain losses. If you have your money at a bank, say in a checking or a savings account, those assets are protected by the FDIC or the Federal Deposit Insurance Corporation. I discussed it in this video in case you missed it. The NCUA, the National Credit Union Administration, protects money at a credit union. The SIPC, on the other hand, protects your cash and securities at SIPC member brokerage firms. The term security means any of the following: note, stock, treasury stock, bond, CD held at a brokerage, etc. Note, the CD held at a bank is not protected by the SIPC. Only one held at a member brokerage is. You can get the complete list on the SIPC website linked in the description. At the bottom of the list, you will see what the SIPC does not consider security. It is crucial to note that the SIPC only protects custody function of your brokerage. It does not protect against the decline in value of your securities due to market movements. Simply put, your securities are covered if your brokerage goes out of business. The underlying value of the securities is not. If you bought penny stocks of your own volition or because of bad investment advice from your broker and the stock value declined, SIPC does not protect you. Here's an example. Let's say you owned 100 shares of Tesla and 100 shares of Silicon Valley Bank as of December 2022 in your brokerage account. On March 22nd, your brokerage firm collapsed, hypothetically. The SIPC will make you whole on your 100 shares of Tesla or what they were worth when you file your SIPC claim. However, your Silicon Valley Bank shares are worthless and SIPC will say, not my problem. Hence, it's important to make investment decisions wisely. The first thing to verify is whether your brokerage is an SIPC member. This page linked below lists all SIPC members. You use the search bar to look for your brokerage to ensure SIPC membership. Most brokerages also list their SIPC membership on their website, but it's always a good idea to check directly on the SIPC's website. All registered brokers or dealers in the US automatically become SIPC members, with some exceptions. Here are the exceptions. Brokers with principal business conducted outside the United States, open-end investment companies, annuities, insurance, etc., and brokers dealing futures products. In the unfortunate event that your brokerage goes belly up, you need to file a claim immediately with the SIPC. If a broker goes out of business, a court will appoint a trustee for the broker. Under SIPC's oversight, the trustee will try to restore cash and securities to investors as soon as possible. They may also arrange to transfer investor accounts to another brokerage and notify all customers if their accounts are transferred. Even in that case, SIPC asks that you file a claim immediately and before the deadline. Once the trustee reviews your claim, you will receive a determination letter. If you agree with the letter, you will receive your securities. If they cannot find your securities, SIPC funds will be used to purchase the exact number of securities that went missing on the open market. If buying those securities is impossible, you will be made whole through cash. Here's an example. If you owned 100 units of a security as of the claim filing date, you would receive 100 units of the same security. However, if that security is not available, you will receive cash, which will equal the value of those 100 units as of the claim filing date. I'm not sure what the tax treatment on this recovered amount is, because think about this. Had you sold your 100 units of this security, you would have to pay income tax or capital gains tax on capital gains, depending on how long you held them. Because in this case, it's an insurance payout. I didn't dig into this much, but found this form 4684, which deals with casualties and thefts and has a data line for SIPC recovery. If you've had to deal with this situation, I recommend talking to a tax expert. And if you have already dealt with this type of situation, I would appreciate it if you could detail it in the comments below and let the community and me learn about it. How soon you receive your assets depends on how complex the liquidation is or the transfer is, how accurate the brokerage firm's records were, if fraud occurred, and your asset size. Remember 2008? Two things happened in 2008. First, many things happened, but I'm going to highlight two things. First, Lehman Brothers collapsed. SIPC stepped in to protect customer assets within weeks of the collapse. More than 92 billion customer assets were transferred. However, it took 6 years to complete 100% distribution to customers. One more thing happened in 2008. Any guesses? Bernie Madoff Ponzi scheme. He had been committing fraud for many years, but confessed in 2008. If you don't know about Madoff or don't remember what he did, watch the Netflix movie about him. 2008 is when SIPC stepped in to protect investors. If you go to the SIPC website today, in March of 2023, the Madoff case is still open. And that's the reason you must have a liquid emergency fund and not keep all assets in your brokerage. Learn about building the emergency fund here. Now let's look at the protection limits. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. So if you have a brokerage account with $300,000 in cash and $200,000 in securities, your account is covered for $450,000 because $250,000 of $300,000 cash is covered. If you keep a lot of cash in your brokerage, SIPC protection may not be enough. Now the limits are for each separate entity. Let's look at what that means. Let's say you have an individual brokerage account, an IRA, a Roth IRA, and a UTMA account at the same brokerage. Each of these accounts is protected up to $500,000, and this includes a $250,000 limit for cash. So your IRA is protected up to $500,000, which includes a maximum cash protection of $250,000. Roth IRA is protected up to $500,000, which again includes a maximum cash protection of $250,000. The same for the UTMA account and your individual brokerage account. This gives you a total coverage of up to $2 million, which includes a cash coverage of up to $1 million. But if you have two individual brokerage accounts, those assets are combined. So let's say each of your brokerage accounts at the same firm has $500,000 in assets, totaling $1 million. SIPC only protects $500,000. When your total asset size exceeds the SIPC limit, you may be better off opening brokerage accounts at two different brokerages to spread your risk. The probability of two brokerage firms going bust simultaneously is low. Not impossible, but low. But suppose you have an individual brokerage account and a joint brokerage account with, say, your spouse. In that case, those accounts are treated as separate capacities, and each account has a $500,000 protection, including the $250,000 cash protection. If you had all those 5 accounts that I just mentioned, your Roth and UTMA and all that, your total coverage would now be $2.5 million. If you have assets above the SIPC protection limit and your brokerage goes bust, tough luck. I'm kidding. Major brokerages have excess SIPC insurance. A private insurer and not SIPC provides this insurance. Contact your broker if you're looking for this information as it applies to you. So brokerages refer to SIPC as SIPC. So make sure you say SIPC, or some of them may not understand what you're talking about. Fidelity provides total excess coverage for all clients of $1 billion. There is no per customer limit on coverage of securities, but there is a per customer limit of 1.9 million on coverage of cash awaiting settlement. I'm laughing because I'm thinking about what it would feel like to have 1.9 million in cash in my account. Schwab provides total excess coverage for all clients of 600 million. Schwab protects up to $149.5 million per customer, of which 1.15 million may be in cash. Vanguard didn't specify the limits, but if you know about it, please let me know in the comments so everyone can gain from that knowledge. Finally, which account did I miss? A very important one. Your 401k or 403b or 457. These are employer-sponsored retirement plans. ERISA, the Employee Retirement Income Security Act, governs retirement plans offered through your employer. ERISA sets minimum standards and provides various protections for employees. I will not go into ERISA in detail in this video, but I want to highlight that if your plan administrator or sponsor goes bust, your assets should be protected. However, it's still a good idea to review your plan assets regularly. While you wait for the next video to load, like this video and share it with one other person who you want to help. I want more and more people to start saving and investing in their family's future. As always, don't forget to be happy, to be kind, and to be your best self. Bye.